Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Rahul Khanna, FX strategist at TraderMade. Thank you for coming in today, Rahul. We're going to look at the dollar. We'll start off with the dollar index. Now, technically, where can we go from here? Obviously, picked up since autumn or the start of autumn, but is the dollar going to give a bit back as we go into the year end?
Yeah, that's a $1,000,000 question. Where's dollar going to go from now?
Yeah.
I think there's a lot of focus, and there were hopes that dollar seems to be formed a head and shoulder base. Technically, we're looking very bullish, but then recently we've seen this rejection in dollar, and sort of it's not looks as neat as it looked, probably a week ago. So a lot has changed in a week. I think this has largely been on the back of US tax reforms, which have taken a hit. Market now is doubtful if these tax reform will come in as quick or to the level as they earlier thought. And this is what driving this risk sentiments in the market. So we've seen a bit of a drop, but then US inflation rate today is quite important. If we see US inflation rate spike to the upside, then there is still opportunity that that 92.54 on the dollar, that area could support it over the coming days and weeks. But the flip side is if US inflation does miss, then I think the hopes that this is a recovery phase could become less. So this is what the chart is also talking about, that it's still sort of constructive because still above those right shoulder in head and shoulder base pattern, and also economic wise, even though there's a lot of noise and in the market right now, essentially nothing much has changed in the grand scheme of things. Is obviously the tax reform is a big deal, but apart from that, I think if US inflation stabilize, or because it's been going for the last 6 times, it's been sort of undershooting and it's been sort of weak. So if it can show sign that it's improving, then it will keep hopes that Fed looks very likely that it's going to go ahead and hike in December, but market looking past it now for the next year, and if inflation does show that it is improving, it will give more hopes to commodities and yields, and hence dollar will stabilize, and probably we'll see a continuation. So a lot depends on what happens on US inflation. If we look at the next
yield chart, the 10-year yield, which a lot of traders obviously will look at as a key indicator and a benchmark. Below the 240 level, which some had seen as key. Yeah.
So at the moment, as you can see, it's also forming a head and shoulder, top pattern, which is different from the dollar index, which is forming a base pattern. So this should be forming a base pattern, but it is not. It's doing the opposite thing, which is sort of there's divergence there. They're telling us different things. But again, like I said, they're still above those levels, above the 230 area. And as long as it's above there, it'll be the same story, that dollar could still go up. And this also depends a lot on what happens with the inflation and how market reacts in terms of risk sentiment. And I think I would look for yields first up to see if what's going to happen on dollar index, if that 92.50 will break on the dollar index. So if we do see a break of 228, 230 area, it will be sort of a completion of this top pattern, and I think we can see dip back to the 2 area, and which would also mean that this base that we're talking about on yields, 10-year yields, that they're basing, those hopes will also be averted. So obviously that will mean the dollar index itself plummets along with dollar yields. So I think I will look for dollar 10-year yield as the main indicator, so to say.
And this look out for that head and shoulders pattern forming there. And moving on to dollar yen, which people look at the yield differentials, and certainly there's been divergence there. And also with the Nikkei as well has had a strong performance, and there's been some divergence there. Just talking through, looking at the dollar index, if we see that sell off, we see the yields come off. Obviously, with dollar yen, we'd expect this to move to the downside.
Yes, so that's exactly right. So if yields were to come off, if you look at this sort of this is a weekly chart on dollar yen, so it's not quite obvious to see what's happening. But this is quite. It's moving quite exactly how the yields are moving. So US 10-year yields is driving the yen. So if yields rise, dollar yen rise, and if yields fall. So over the past few months, it's exactly spot on. So again, if that does top out, we'll see that 111.61 level break. And then again, this thing about dollar yen also making a base and probably moving above 114.50 would be averted in the short run. It's still, as long as above 108, is still, in the medium term, we still think is going to go higher. But the immediacy of dollar yen move higher would be sort of averted if we see a correction in yields, and similarly we'll see a correction in dollar yen below the 1160. So 1160 becomes crucial. Those people are still hopeful that dollar is sort of this is just a correction, like an opportunity. This is not a bad idea to buy it, but I will look at how market reacts post the US inflation rate. And after the inflation rate, it'd be a good chance to see how dollar reacts. If dollar doesn't react too much, then a good opportunity to probably buy dollar yen lower down. Even if it breaks that level, probably at 109 would be a good opportunity to buy it. Because all of these moves that we're talking about today, they looks like short run driven. So that's, I think dollar yen is still looking constructive, but yields will show the way.
On that note, very key, yields will show the way. Take a look out at the 10-year US Treasury. But in the meantime, Rahul Khanna, FX strategist at Trader May, thank you for joining us.
Thank you for having me.